Welcome to my channel. I am the covered call guy, and this is my journey to creating a 120,000 per year passive income portfolio. It currently yields just about $17,000 a year, so we're up from 61,000 when I first started this channel. I'm gonna be hitting my goal strictly using covered call ETFs. And when I reach my goal, guys, leave me a comment. I'm open to new ideas on which new stocks or ETFs or where I should pivot. Please, I welcome everyone giving me new ideas. Maybe I should explore new things besides cover call ETFs. But anyways, legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. All right. I am just some random idiot you found online, and I could be completely wrong. All right. With that out the way, today's video is going to be on synthetic cover call ETFs. I see a lot of people buying cover call ETFs and not knowing how it actually functions, right? There's different type of cover call ETFs. Not all cover call ETFs are the same, okay? Every single cover call ETF has a different strategy behind it. So please understand what you're buying. Do your deep dive into, you know, how that ETF is structured and its strategy, how the fund manager executes it. All right, so let's get started. All right, so are synthetic cover call ETFs dangerous? This is my deep dive into the structures, risks, and dangers of them. All right, what are they and how they operate? Deconstructing the synthetic label. All right, what is a synthetic cover call? All right, the goal is replication. A synthetic strategy replicates the exact risk reward profile of a traditional cover call, long stock plus short call, without the high cost of buying the stock outright. Right, the mechanics: it uses derivatives options to create a synthetic long stock position. The fund then sells a call option against this synthetic position to generate its income premium. The purpose of it: the primary goal is capital efficiency, less cash needed upfront, achieving leverage, or executing specific complex management strategies. What is the exact options strategy? Right, strategy one, PMCC, and it's slash diagonal spread. It's just two terms but means the same thing. PMCC just means poor man's cover. PMCC is a type of diagonal spread which involves a long-term, deep in the money call option, then which acts as a replacement for owning the stock synthetic. A short-term, near the money call option which is sold to generate the income, similar to the short call in a traditional covered call. Right, strategy two, synthetic long combo. This structure combines put and calls to create the stock position, right? The stock, synthetic stock. You then buy an at the money call and simultaneously sells an at the money put, same strike and expiry. This combo replicates the stock, right? Profit loss. Short leg sells a separate short-term out the money call against that combo for income. It all sounds great, right? It's like, whoa, so what's wrong with it? So these are the definition and how it works. Right? Are they using leaps or short-dated options? For the most part, both, right? They combine long and short-term options, a critical combination. Understanding this combination is key. The strategy is not one or the other. It is a spread that uses both to operate. Leaps, which is long-term options, right? Often used for the stock replacement. It is a deep in the money call. This leg is held for many months or years, right? So a leap is most likely a year out. Short dated weekly, monthly, used for the income generation leg. The out the money call, they sell, right? They sell out the money call, right? This leg is rolled frequently every 70 to 30 days to harvest time decay. Well, what's the risk, right? The counterparty and liquidity risk, right? Understanding the structural dangers of synthetics. What is the counterparty risk? Well, risk one, exchange traded is very, very low risk. Most US ETFs use standard options traded on a regulated exchange like CBOE. The counterparty risk is mitigated by options clearing corporation. It's just like a holder. Pretty much think of it like an escrow, right? Like a third party, right? The OCC acts as a central counterparty, becoming the buyer to every seller. It guarantees settlement and virtually eliminates individual default risk. This is a primary protection. All right. So risk two, OTC, over the counter, swaps, high risk. Right. These are high risk because some ETFs use ELNs, equity linked notes, or total return swaps directly with an investment bank, right? JP Morgan, Goldman Sachs. In this structure, the counterparty is the bank. The risk is a direct default by that single entity, similar to the risk seen with Lehman Brothers in 2008. So yes, there are very, very big risks to this. Now the probability, of course, we don't know, right? Probability can swing, start from low and swing very high in a split second. How is counterparty risk mitigated, right? The OCC, the clearinghouse, right, mitigates risk by interposing itself into every trade. It requires all clearing members to post significant margin and contribute to a massive default fund, which is stress test daily. And then explain like I'm 5, because again, I always want to assume that every viewer is new and investing and they just want to understand, right? So think of the OCC as the grown-up in the middle of a trade. It holds the money. If one side can't pay, the grown-up pays from a special piggy bank. This makes sure no one gets cheated, right? And then the other counterparty risk is the calendarization, for swaps and ELNs, right? For OTC derivatives over the counter, the bank counterparty must post high quality liquid collateral to the ETF. This collateral is designed to make the ETF whole if the bank defaults. This is like a pinky promise with a deposit, right? Explain like in 5. The bank gives the ETFs a pile of valuable stuff, collateral to hold. If the bank breaks its promise, the ETF gets to keep the pile. All right, and the third one, the true risk for swaps. The danger is not in just the default, but that the collateral itself, right? If you use bonds, example bonds, becomes illiquid during a systematic crisis, making it difficult for the ETF to sell and recover its value, just like 2008. Everyone thought housing was super safe and it would never fail, right? The quote, who doesn't pay their mortgage? Well, it seemed like a lot of people did. Explain like I'm 5. The problem is, what if that valuable stuff suddenly becomes worthless? If everyone is scared and is selling, the pile the ETF is holding might be impossible to sell, so they still lose money. How liquid are the options market in a crisis? Normally, markets for major indexes like SPX and ETFs, SPY and QQQ are extremely liquid, right? With billions, damn near trillions in daily to monthly nominal volumes. In a market stress, volatility spikes, liquidity evaporates, market makers fearing risk pull their bids and offers. But for the most part, it is still pretty safe. Now for synthetic, we don't really know. The impact slippage, the bid-ask spread widens dramatically. The ETF is forced to roll its position, which means buy back old, sell new at terrible prices. This slippage is a direct transitional cost that reduces the fund's income right when volatility is highest. And then performance and cost analysis, right? Tracking errors, fees, and hidden drags. For the most part, these would be minor, right? What is the basis risk and tracking error? Base risk is synthetic versus traditional. We're going to compare the two. This is the risk that the profit loss PL of the synthetic option position will deviate from the PL profit loss of a traditional cover call, right? So long stock plus short call, right? The result of this, well, this risk is fairly low, historically fairly low, right? Historical simulations and parity rules confirms that PL profits are virtually identical. Tracking error, ETF versus index. This, I would say, this is more the real issue here. Is the risk? It is the risk that the ETF return will deviate from the underlying asset. Example, the SP 500. The result of this error is intentionally high. The strategy is designed to underperform in a bull market because it sells away all the upside gains. This is the feature, not a bug. Well, what are the total fees and operational costs? Again, expense ratio using MER, 0.35 to 0.95, right? So again, this is really this just an illustrative chart. It could be very different just depending on the stock you hold. This is just to illustrate that it could change depending on which ETF you hold, right? So you just have to be aware of the high fees, the hidden costs, right? So it creates a significant drag on your income. How is time decay and volatility managed, right? Time decay, that's your engine, right? The ETF is a net seller of options, so it is long theta. It profits as the short dated options. It sells lose value every single day. This time decay is the primary profit engine and the source of the fund's income, right? Volatility, right? The dilemma. You have to think about this and you're like, oh man, is this worth it? The ETF is a short vega. This creates a dilemma. High IV, which is good for income, right? Premium high, but bad for capital. Usually means the market is falling. Low IV, which is volatility, bad for income. Premium is low, but good for capital. Market is calm, right? So come to conclusion, income is inherently unstable and pro-cyclical with fear. Tax and drawdown dangers, right? The most critical and misunderstood risk. What are the tax implications? Again, a lot of these are going to be depending on your ETF and their strategic tax advantage strategy, right? These are just an example here. Qualified dividends like Microsoft, option premiums, traditional cover call on Microsoft. That's if you're doing it yourself. ELNs like JEPI and JEPQ, right? The ordinary income, and ROC, the distribution, right? High yield, zero date expirations, and then section 1256 gain, index option ETF, 60/40 blend. So these are just examples of what you should be looking for when you want to pick your cover call ETFs. How is their tax implication? What is their strategy? You know, how are they trying when they pay me out weekly and monthly? Do I have to worry about tax? Should I put it away like a paycheck? If it has a long history, then you can always fall back on that, but it's not always accurate. The most accurate would be at the end of the year. So I always say treat every paycheck like treat every payout like a paycheck. That way you do not have to worry about taxes at the end of the year. Because if you spend everything, but you shouldn't anyways, right? You treat it like a paycheck. So enjoy your life, have fun, or reinvest it. Or if you have a job, use your job as a cushion for taxes. So put some of additional money from your paycheck and like, all right, this is not for investing, this is for taxes for later, right? So that way you get in a habit of that. How significant is the drawdown, which is the loss, the risk? The number one danger is the myth of protection, meaning the premium received offers negligible protection in a crash. All right. Whew. It's been a long day, sorry. All right, we're going to use a case study of a 2020 COVID-19 crash because that was probably one of the most recent and most memorable. The SP 500 dropped 32% versus a cover call index like BXM dropped 29%, right? The strategy captured almost all of the downside, but has already sold away all of the upside, right? This whipsaw effect is structurally guaranteed to destroy long-term return versus holding the index. So you understand how your cover call will perform and the strategy. All right, the verdict, right? So synthetic versus standard and when to use them, right? Synthetic versus standard cover call ETFs, right? A synthetic cover call, right? Very simple to understand, right? You own the stock and receive dividends. That's the standard, right? Cons: high capital cost, must buy 100 shares. Of course, not you, but the cover call ETF that holds is, they all have to follow that same rule, right? Premiums taxed as ordinary income. I put that there because even if your cover call ETF is like, hey, we're gonna do 100% return of capital, or we do a 60/40, none of that is guaranteed until we get the final 1099 from our brokerage, right? So we always assumed it is taxed as ordinary income. That way you have a margin of safety, right? And synthetic cover call: highly capital efficient. You have to use less cash. Less cash means you're able to buy more, but that is also going to be a downside, right? And another pro is potential tax advantage. I use that even though it could be a con, but we don't really know. I just have that there for another pro. And then con: complex higher management fee and no dividend received from the asset. And then highly capital efficiency, less cash, also means that you can be over leveraged into this. Okay, always remember 2008. Everyone thought housing was unstoppable until it wasn't. When is a synthetic ETF preferable, right? So these are three things that I've listed out, and it would be preferable for me if I were to agree with all three, and it would have all three, right? For capital efficiency, an investor want the cover call payoff profile, but wants to free up capital for other investments. Of course, this is for the cover call ETF, not you, but you gotta think like you're owning the cover call ETF as if it was you. So the synthetic structure provides this leverage for tax management. A high net worth investor in a taxable account specifically chooses a fund using section 1256 index or the 60/40 blended. And if the ETF is using it as a tactical tool, right, it is used short term to generate income in an expected range bound or slightly bullish market, not as a long term buy and hope replacement for stock. And a lot of people get confuse this, or don't read up on this, or just don't know about this, right? So synthetics, one of the reasons why I prefer traditional over synthetic is traditional, you hold it and you can pretty much buy and hold, right? Synthetic, you don't actually create anything of it, so you have to give it away. You need to give it away, right? Whereas if the stock is holding the underlying, well, you don't really have to worry, because if you don't give it away, you still collect the dividends, you still collect the payout, right? So understand, the pros and cons. Final verdict: what type of cover call ETF is for you, right? For the traditionalist standard cover call ETFs, this is where I would go, right? Choose this if you prioritize simplicity, want to receive the stock's actual dividend, and prefer holding the underlying asset best in tax sheltered account or brokerage account, because again, depending on your cover call, they can be given out tax advantage dividends. For the capital efficient, right, synthetic cover call ETF, choose this if your main goal is capital efficiency, leverage, and you want the cover call payoff without the high cost of buying 100 shares. Again, you got to think like the cover call ETF, right? You're not buying it, the cover call ETF, right? So if they're buying it, or they're using this synthetic strategy properly. And then for the tax strategist, of course, this is going to be in both. Section 1256 ETF, choose this only in a taxable account. This is specific synthetic fund on the SPX to get the favorable 60/40 blend. Again, the tax strategist, it applies to both traditional and synthetic. It's just this part is just knowing what you own and how the fund operates and what the strategy is. And then these are just the key sources and data that I use to build this presentation. Subscribe, comment, like. I hope you guys enjoyed the video and give you a better understanding of what synthetic and traditional cover call ETF. I've been seeing a lot of people buying cover call ETFs and not knowing that it's synthetic, that it doesn't even own the underlying. They don't even own the holdings, and that could backfire. That could probably be terrible for the NAV growth, right? You want to own the underlying because it is a well, for me, you want to own it because, in my opinion, right, owning the underlying means you're owning especially if the underlying is great asset, strong asset, has a moat, right? So you don't want synthetic, because synthetic, think fake. Synthetic equals fake, and fake is personally for me, Fugazi is never good. So thank you for watching the video. I hope you guys learned something from this. Subscribe, comment, like, let me know what I should be making, or if you want to do a deep dive in one of your cover call ETFs, please comment, and I will go and probably make a video on that. All right, thank you.